Good afternoon, guys. My name is Rob Pietropaolo, otherwise known as Robbie P. I'm a private client trader at Vunani Private Clients, and I'd like to welcome you all to the JSE webinar, where today we're going to be talking about how to use technical analysis in your investments. Right. Now, what I hear a lot is that guys look at charts and kind of don't really understand what they mean or what they're saying. So a lot of my clients specifically go, well, I can't read charts and that's your job. But that really doesn't help them with their investments when they start asking what went wrong, or why is this price going down, or why is the price going up, or should we be buying this right now, or should we be selling this right now. So today I'm going to show you in a very concise toolbox how to understand and read a chart and get the most benefit from it in your investments. So anybody can read a chart if you know what you are looking at. So what is technical analysis? So while fundamentals drive stock prices, and by fundamentals that is changes in management or the profitability of a company or lack thereof, the use of technical analysis is everything you need to help you better time your entry or your exit. So all technical analysis really is a visual interpretation of price action or of a stock or an index price behavior. So the best strategy is to trade what you see, not what you think. So your strategy must be simple, it must be easy to understand, and more importantly, easy to implement. And by implement, I mean you have to have a plan. Okay, so a technical strategy that I'm going to give you now is a boiling pot of a few ingredients that are going to help your soup taste better in your longer term investment. Guys, charts help you cut out the noise. Okay, so as an investor, you're a little bit longer term. You're in it for the long haul. So by cutting out the noise, by using your charts, you will know when it's time to either get in or out of a bad trade. So what are the elements of a good strategy? Now you need to understand yourself, but also understand what the charts are telling you. And this is where we start. So firstly, you need to understand what is your time frame. How much realistic return on investment do you want or can you expect from an investment? How much are you prepared to lose? Very important. A lot of guys get stuck in very bad trade, and we refer to that as being married to a trade. And sometimes my boss even sings, he fell in love with a hopeless trade. So make sure you don't fall into that trap when you start looking at investing. Very important is to set entry, take profit, and stop levels when entering a trade, because it takes a lot of the emotion out of a trade when it goes wrong. Trade liquid instruments. You need liquidity. It must be easy for you to get both in and out when you want to take profit. But we'll discuss that a little bit later. And wait for confirmation of direction. Direction is very important. As a longer term investment or investor, you don't want your direction to be down. You want all of your investments to trend upwards. A trend that's going down, or a trade or a stock price that's going down, doesn't benefit you at all. So this is all part of the plan and the elements of a good strategy. Taking profits early if market conditions dictate. A lot of you guys would have seen or heard on the news wires that this was probably the worst September-October trading period in the last 30 years in the US. And that of course affects our markets and indirectly our instruments, or directly our instruments. So if market conditions aren't conducive to getting into investments, you should stay out. And if you're in, probably not a bad idea to get out until conditions settle. In other words, we're going to trade what we see. So let's go back to time frame. So time frame would dictate what chart you need to look at, and it helps for you to identify what point or part of the trend or price move you are in. Now charts are very pliable. You can look at the daily price action, weekly, monthly, right up to yearly. And all of these little bits of information are very important to help you time your entry into the market. Because a lot of guys do go by the prophecy of it's time in the market, not timing the market that makes you money. But I'm going to show you how to best guess the best time to get in the market and stick with it for the long haul. So first of all, I prefer to use candlesticks. Now this slide just is an explanation of how candlesticks work. Now each of these bars is referred to as a candlestick. And what each of these candlesticks tell you is very, very important information. So first of all, they give you what the high of that time period was, the low, the open, the close, and how much volume traded in that session. Now, as per the previous slide, your time frame is what matters. So if you were looking at a daily chart, each one of these candlesticks would have been the session information for that day. Similarly, if you were trading a weekly chart, every single candlestick would contain the data that occurred in that week. In other words, the open of that week, the close of that week, the high and the low and the volume traded for that entire week or month. So depending on what chart you're looking at, this is what all of these candlesticks will explain to you. So let's go back to part one of our plan. How much return on investment do you want realistically? Now, as I said before, charting or technical analysis is a visual interpretation of what prices are doing. Okay? Now here is a very basic chart, and this is an older chart of Discovery Holdings. Now initially it just looks like a chart that goes up and down, but as a technical analyst, this actually tells you a lot more about what's going on with this share price. Okay, so let's first see what's the first thing that I see when I look at this chart. We can see that this chart or this price has made a high and then subsequently come off to a level to make a retest of that previous high before falling back down again. As you can see on the bottom of this chart, this has spanned over a few months. So from October last year, November, December, January, up to February, almost ending at March. What else do we see on this chart? Quite a lot of information. So this simple chart actually starts looking a little bit complicated, but it isn't, because we're talking about investments. Now remember, one of the things I alluded to was set your entry and take profit and stop losses in when entering your trade, and this is exactly why. So now look at the information this trade or this chart has given me. I know, or I can see, that it made a low point at some stage in October to make a high before selling off, to retest the previous low where it bounced. Now guys, a lot of guys would have waited for this low to be confirmed, and now when we go back to how much are you prepared to lose, we can see that kind of failed over there. But this goes back to being realistic about your expectations of what the share price is going to do. I'm going to get into a lot more detail, but I just want you to see that a simple chart actually conveys quite an important message and has a lot of detail in it. So if you had bought this stock at a support level similar to the previous low, you should theoretically, by that logic, also not be too greedy and probably get out when it retests that previous high. But let's say we got in a little bit late, and this is part of the plan. Go back to set your entry, your take profit, and your stop loss levels when entering a trade, because trades can go wrong. So let's say we wanted to get in now on the third test of the low for a profit target for a retest of those highs. We would have had to enter a stop loss level in case this goes wrong, because they do go wrong. So we would have put our buy price similar to these lows. We would have put our take profit very close to those old highs and a stop loss level just below these lows. Okay, this trade obviously would have gone against us, and if we had not gotten out at the right time, we would have probably lost roughly about 30% of our investment. Now nobody wants to do that when they're investing, and that's why you need to cut your losers early, because there's another cost to you as an investor, and that's called opportunity cost. Missing out on the next trade because you're stuck in a bad one is just as much, if not more, of a sin than losing out on any profits. So typically, an investor would need to be patient, wait for this share price to recover, get back above those old previous lows before getting back into this stock. And guys, this chart goes back a little bit, and on a retest, I bought this stock around about the 70s, and I think Discovery today is trading at about 96 Rand. So this is just to give you the principle behind having the plan before you get in, and be realistic about how much you're prepared to make, and how much are you prepared to lose is probably more important because of the opportunity cost. Now, liquidity, as I referred to earlier, is of paramount importance. You need to be able to get in at a good price, and it must be easy for you to get out when you want to take profit. Okay, so here, side by side, you might have to sit a little bit closer to your screen as the slide might be a little bit small. But at a specific time during the day, let's call it 12:30 in the afternoon, here is an order book of two very different stocks. We have a very liquid Sasol and a very obscure Huangi Collieries Limited at exactly the same time of the day. Now look at the difference between these two stocks, and this is what I talk about when I talk about liquidity. On the order book currently, or at 12:30 in the afternoon, Sasol, on the buy side of the order book, has got 128,000 shares that are prepared to be bought at various prices, as well as 81,000 on the sell side. But you can also see that the bid-offer spread is very close. In other words, the buyer wants to buy at 129 Rand and 30 cents, call it, and the seller is prepared to sell at 629.84. Now you don't have to cross a very, very wide double to get in or out of this market. You might forgive yourself a few cents for the ability to get out of a trade, or in for that matter. But as you can see, there's active trading that's happening in a liquid stock like Sasol. At the same time of the day, we have an illiquid stock, and this is the problem. For all you guys that are trading those penny stocks and wondering why you've been waiting for that 10 bagger to come in and you keep losing money, it's probably because it's very difficult to get out of those stocks, and very importantly, the bid-offer spreads tend to be very wide. And by that I mean the best buyer on this specific stock is sitting at 60 cents, and the best seller is not prepared to sell lower than 1 Rand 50. Now guys, you have to be a fool to pay 60% more for a stock you want to hold, because remember, when it's time to sell, you're probably going to sell it for 60% less than what it's worth. And that is not the purpose of investing. So very important, trade liquid instruments. And I think this depicts exactly why you need to look for those liquid stocks. Then we get to confirmation of direction. Guys, again, technicals is a visual interpretation of what's going on with an instrument and its price. Okay, so quite easily we can see visually that the trend is bullish or upward moving. This is what we want to see when we want to get into an investment. I don't like to see downward trends when I'm investing, because over time I would like my investments to go up. But you do need a little bit of help to see if this trend is going to be lasting over the period of time that I want to hold it. So typically, linking a series of bottoms does give you the direction of the trend, but you also need to add to your charts what's called a stochastic oscillator and a relative strength indicator. And what these things do is give you an indication of what's happening with the momentum. What are the buyers doing and what are the sellers doing with the specific price of that instrument during this time. The relative strength indicator is this green line that I've circled, and it indicates how strong or weak the price is at this point in time. So this might be this month, or this week, or this year, or even this minute. Okay, so the minute we start seeing an upward turn in the relative strength indicator, it means that buyers are starting to come into the price. Now, why is this important? We go back to the stochastic oscillator, which is the blue and the red line. This kind of gives you the momentum, and I will get into a little bit more detail in a few slides' time. It indicates where buyers tend to take profit or where they tend to start buying. And normally these two indicators coincide with each other, because as the relative strength indicator starts to turn up, an oversold price will start ticking up and making its way as new buyers come in. So there's two little sets of confirmations. Typically, when stocks are overbought and guys start taking money off the table, a price will tend to come down because they're selling. They're taking profit. This is by no means time for you to panic because you're a long-term investor. It is just an indication or a signal for you to know that when the time is right to get in, or if you're looking at exiting a trade, when is the best time to maximize your profits. So let's get a little bit more technical. Okay, guys, taking profits early if market conditions dictate doesn't mean panic in a Wall Street sell-off. Last week, our market wiped off about 3,000 points. Long-term investors should not be scared of little corrections like this because we're in it for the long haul, and our market averages about 16% per year that it goes up. And that includes the crash of 2008, 2009. So we do need to cut out the noise and not be scared of little corrections. But it's probably not a bad idea if you're in the capital preservation stage of your investment to maybe look at taking some money off when companies start giving you poor trading updates. That's normally a signal that that share price is probably a little bit overvalued, and that if they give you profit warnings, that this company is probably not going to be performing as strongly as it has been for a little while to come. Again, that boils down to opportunity cost. So maybe look for something else that has a little bit more promise. Or even bad economic indicators, things like a weakening economy. If you're invested in some offshore shares that might have exposure to Germany or the DAX, where you start hearing whispers of Germany might be slipping into a recession, or Europe might be slipping into a bit of a recession, it's probably not a bad idea just to take some money off the table, cash in on those stocks, wait for the market to settle a little bit, and wait to time your entry again. And you can do all of this on your charts because charts represent what prices are doing. Also, guys, strike action if you're holding counters. Like mining stocks, we all know what the platinum strike did to our economy and the broader mining sector. You don't want to be involved in noise like that as a longer-term investor. So when these things start settling down, it's probably the best time for you to get back in. As soon as your charts let you know that this is the bottom and this is turning and momentum is going back in your direction, you could probably get back into a decent investment at much better prices. And just to remind you, always have a plan when you get into your investment. Set your entry, set your take profit and your stop loss level before going into this investment. And this is very important because it takes the emotion out of trading. Nobody wants to be stuck in an Anglo-Platinum trade at the peak of the platinum strike, violence, unrest, and the dire effect it has on the economy, and then not knowing what to do. A lot of my clients phone me and go, what do I do now? Now this guy that's asking, what do I do now, would never have had to do that if he had a firm plan in place right at the beginning, knowing the dangers of what could possibly go wrong, and if things go wrong, get out and stick to the plan and get into something else that's going to make you money. And this is where charts are important. So here's some technical tools for you guys just to get you on the right track. We're going to look at support and resistance. I've touched on the stochastics, the moving averages that are most important, and I think there's only one as a long-term investor that we need to touch on, and the trend, which I've also touched on. Now, quite simply, support and resistance. Support is generally an area where buyers come in and think there's value and start supporting the price. Conversely, resistance would be the opposite of that. This is where investors would typically think this share price is a little bit too expensive or maybe a little bit overvalued, and I'm going to take some money off the table. Now, here's a small example of a ranging share that has a very definite horizontal support and a horizontal resistance. Guys normally coming in here, taking their money off at the top. And this could carry on for quite a while. This is a very basic interpretation of support and resistance. The darling of the stock market, Aspen, also an older chart, but this is just to prove to you as a longer term investor that you should be looking at both rising supports and horizontal supports to help you best time your entry. Because if you're getting into a solid company with solid performance and a solid trend, your investment should give you solid returns without worrying about the dips and the noise in between. So let's first look at rising support. Quite simply, we again are touching bottoms and we have a visual trend that this share price tends to go up. Now, if we combine the concept of horizontal support as in the previous slide, horizontal support is we need to find this little bit of a bottom, somewhere where I can get in, somewhere where investors are looking for value, somewhere guys are starting to pick the stock up. And this is where the stochastic oscillator is going to help you a lot. But the perfect trade is going to be one where a rising support and a horizontal support meet. That is going to give you your best odds and the strongest possibility of higher returns. So very easily look for points of horizontal support and be patient on this, because if you had bought this previous breakout on the stock, or you might have missed this previous breakout and you might have had to wait 2 or 3 months for this stock to come down to your support level, guys would have got anxious and maybe bought it a little bit too late or even too early. But as this rising support comes up, you start getting stronger and stronger areas of support. Now this is a chart that I based my own long-term investment on, and I did buy Aspen at around 265 Rand. And the share price today has broken out to make new all-time highs. And I think the last trade before I left the office to come and do this webinar was 354 Rand. Now the moving average I want to talk to you about today as a longer term investor, this is where you switch over to your daily chart to see how the short-term price relates to itself over 200 days. So it's the average price of this stock over the last 200 days gives you a very, very good indication of how well or how sick a share is. We like to say that any share trading above its 200-day moving average is healthy and is a healthy stock to buy when the time is right. Okay, dissimilarly, it also tells you when a share is not well. Now here's a little stock that some of you might know called African Bank. Now this is one stock I definitely didn't look at buying in my long-term portfolio. And this is based on the 200-day moving average. So, like I said, if a share trades below its 200-day moving average, we consider it to be unwell or sick. And here's a nice example. So we can see here, in about July of 2012, the share price did get a little bit of support on its 200-day moving average and then broke below it, where lots of guys exited their positions. It then had a bit of a relief bounce, and guys bought this stock, hoping that this stock would go and retest previous highs. Something clearly happened, which must have been very poor guidance on earnings or something like that. And this is a very clear signal that this stock is now starting to get seriously sick. A nice big break of the 200-day moving average, followed by another week or two of selling with a little bit of relief rally. Now guys, this is very important. For those of you who like to buy stocks as they're falling, it's probably the worst strategy you could ever have. We like to call it catching falling knives, and any African Bank investor would have told you that, because you can't see value in a share at 36 Rand. Why would you find value in a share at 33 Rand? And it continues to fall. Okay, so the same as we have an upward trend as before, here we can see a nice, well, not a nice, but a terrible downward trend with absolutely no reason to buy the share. And we all know what happened to African Bank a couple of months ago. It defaulted, fell off the main board, at I think it was 29 cents or 28 cents. And those investors have lost their money with very little opportunity of getting it back. So can you see how important the 200-day moving average is? Healthy stocks trade above this 200-day moving average. Unhealthy stocks generally trade below their 200-day moving average. And that's where the daily chart is important. I'll take you back to the stochastic oscillator. It's not very difficult to understand how this oscillator works, but just the description. It's a technical momentum indicator that compares a closing price to its price range over a certain period of time. Now this period of time can be up to you, depending on how long you want to be in this investment. So this can be set to by the minute, by the month, by the quarter, or by the year. And this tells you exactly what the momentum of the price is doing. So as you can see by the yellow dots, the little down portions of the share price normally coincide with the period where the share happens to be overbought, and vice versa. When a share starts turning up out of oversold territory, the share price generally tends to move up. So this also helps you gauge a better point of entry, because it would be kind of silly to buy a share that's been trading in an overbought range for a while. So typically what you would do is you would wait for it to come down a little bit, wait for the stochastic oscillator to come out of its oversold area, and it'll give you a better opportunity to buy. And that way you're going to make sure that the momentum is on your side. And after you've gotten the entry into your investment, then the little dips and the peaks and the troughs after that won't matter, because if you've already identified the trend, when other investors are getting out of the little bounces, your investment is still growing over time. So don't let the little dips be your reason to get out of a good trade. This is just to give you an indication of where you and your investment lie in the trend. And it gives you a good idea of where you are in the cycle. So let's just recap. When picking stocks for your investment, you need these basic technical indicators. Trend. Identify the direction. That's number one. You only want to get into stocks that are going up, not ones that are bouncing up and down or even going down. Support and resistance. Support is where we buy. Okay? If you identify where this price is supported and where people are possibly going to sell it, you're a long way or a big step ahead of the curve. You should be getting in to where other investors start seeing value. Okay, then the moving average, the 200-day. Let's see how sick or healthy my investment is. What do other investors think about this stock? Because if other investors don't want it, I don't want it. And that is what the 200-day moving average tells you. Okay, and then the stochastic oscillator. Identify if the momentum is on your side so that you don't get in too early or don't get in too late. You only buy instruments or stocks or securities that have demand. Once you have something that's in demand, there's no other way for it to go than up. So guys, I hope that this has added value, and it has definitely to profitable investing. And if there are any questions, I'm happy to sit and answer some of the questions you guys might have, whether they be technical or fundamental, or regarding how these technicals can help you with your investments.